When you finally decided to invest your money in the stock market, it's quite hard to decide which companies to invest in, especially with thousands of options available. So in this video, I will share with you a 4-step process on how to identify the right companies for your portfolio. What's up guys, and welcome to my YouTube channel. My name is Mehdi. I am an investor and I love to talk about investing, and in this video I will share with you a process that helped me make money over the last few years in the stock market. So if you are a beginner, this is for you. When I started investing, I was always buying the wrong stocks for the wrong reasons, because of a FOMO or because of something I read on Reddit. I wasn't buying because of the quality of the business or the future potential, and that was my biggest mistakes. So I had to implement a better strategy, and this is exactly what I did. So as a beginner, your first step should be identifying companies you like and understand. You already know lots of great companies to invest in. You just have to ask yourself one simple question: which company do I like and think could be a great investment? For example, here are some of the companies I like and use every day in my life. Spotify, I like music and I love their streaming service. Plus they have a great app. I like Nike. I love their sneakers and I've been buying since I was a kid. Like most of you, I'm an Apple addict. I love iPhones and MacBooks and I love their design and products. To be honest, I feel like they betrayed me when they removed the jack plug, but that's a different story. Tell me in the comments which companies you like and think could be a great investment. Obviously, being a client is not enough. You need to dig a bit deeper to know if these companies could be great investment for the long term. To better understand the full range of products or services, you can obviously have a look at their website or at their annual report on their investor page. You can see here, Apple sells many products and services, including iPhones, computers, tablets, watches, and other accessories, as well as different services. Now that we have identified the company and we better understand the business, it's time to take the next step: assessing the company's financial health. What you're trying to identify in these steps of your research is whether or not the company is financially stable. My rule is to invest in companies that are still growing so that I feel the share price will increase. For that, you will need to read the annual report, also called the 10K. I know these steps might seem difficult and boring, but it's not as hard as you think, and it's very useful. You don't have to make any calculation if you don't want to. Here's what I look at first. Start with the revenue, which are the sales. For Apple, you can see that their revenue have been increasing over the last 3 years, which is a good sign that the company is still growing. We can also see that the iPhone sales are still accounting for more than half their total sales. However, it seems that the iPhone business is maturing. But it's okay, because Apple has new opportunities for growth, and we can see that the wearable, home and accessories and the services categories have both experienced a high increase in sales. Now, another extremely important thing to look at is the net income, which is the profit that the company keeps after expenses. You want it to keep growing too, because that's the money that they will be able to reinvest in the business to keep it growing. And they will also be able to share some of this profit with the shareholders. That's the dividends. That's the money that they will pay you just for being a shareholder. Sometimes a company is not making any money yet, but the share price can keep going up. That's the case with Amazon. Consistently lost money for more than a decade, and now it's one of the most profitable companies in the world. Side note, not all companies grow at this incredible pace. There's nothing wrong with a bit of a risky exposure to high growth companies, but as a beginner, it's better to invest in more stable companies still in expansion phase. Once I know the company is profitable, I look at other indicators of a company's performance. The two most common ones are the EPS and the PE ratio. Don't regard the easy to understand. The EPS is net income divided by the number of shares outstanding. It's the most commonly watched indicator of a company's financial performance. You can quickly find the EPS of any companies on website like Ticker. It's free and it's loaded with great financial information without having to make any calculation. We can see Apple has experienced an increase in EPS over the years, which indicates an increase in profit for the company. The next indicator is the PE ratio, which is the current price of a share divided by the previous 12 months EPS. You can also find this on a website like QuickFS. A high PE ratio could mean that the stock's price is high relative to earnings and possibly overvalued. Don't forget that this number is a bit useless on its own, so you need to compare two companies within the same industry to get a full picture. This spreadsheet here will help you to compare them. You will also be able to compare their debts. Large debts are not always a negative indicator, but rising interest rates could put some companies in real trouble. Now that we've done a quantitative analysis by looking at the hard data, it's time for us to do a qualitative analysis. And here's the step number 4, identifying the competitive advantage. It's also called an economic moat. It's the distinct advantage that a company has over the competition. It could be a brand name, it could be a patent, a system, or even a product. For example, when I think of Apple, I know the company has a great moat, like a strong brand. So during your research, don't forget to ask yourself, does this company has a clear advantage over the competition that can help it grow? Another important point when it comes to comparing companies is the management team. The people at the helm of the company will be responsible for how much the company can grow and how great the company is performing. Apple had a great visionary with Steve Jobs, but under the leadership of Tim Cook, the company had grown from a $400 billion operation to a $2 trillion corporation. Try to get as much current news as possible about a company and its management, because bad news may affect the share price negatively. When it comes to investing in companies, you can go as deeper as you want. But I think as a beginner, this is a great foundation to make sure that you invest in a company that is right for you long term. Here's a little extra. Once you decided what to invest in, when should you buy the stock? People say the best time to buy is now, when you have the money. It's kind of true, but there are some rules that you can apply to better enter the market. Buffett said, be fearful when others are greedy and be greedy when others are fearful, which means that the best time to buy is during a crash or correction. For example, last year in 2020, there was a lot of companies with discounted share price thanks to COVID. You could have double, triple your money with many companies. It's a bull market, which means the prices are going up. Just enter slowly and use what we call a DCA strategy, which stands for dollar cost averaging. Let's say you want to buy shares of Apple. The idea is to buy at different intervals so that you make sure you're not buying at the top, and if the price keeps dropping, you will buy the dip to average out your price. Don't fool yourself thinking you can time the market. If you manage to do it once, it's probably because of luck. So it's important for you to have a strategy. If you want to read more about the DCA strategy, you should have a look at Investopedia. If you have any question about researching companies, please let me know in the comments. Good luck to you. Peace.